Good afternoon, good morning, good evening, wherever you are joining me. Thank you for another episode of our Wealth Video Conference. My name is Oludare Fasola. I want to thank you for joining today again. We're going to be looking into another topic today, but before we go into the presentation, I want to thank everyone for joining. We started this program a couple of weeks ago, and what we are trying to do is to educate business owners and medical professionals on the best strategies on how to grow wealth. So we're going to be looking into another topic today, right? But before we go into the topic, I just want you to please help me as you are joining. Please type your name and where you are joining from. If you are joining from Canada, type your name, Canada. If you are joining from United States, if you are joining from any part of Africa, anyway, wherever you are joining, please indicate where you are joining from and also indicate your name. All right. For It's going to be an interactive section. I will be asking questions, please. And if you have any question, you can drop it in the comment section. When we finish, we're going to quickly look into that. Again, please share this with other people that you think that they might also be benefiting from this amazing program, because we are not paying for this, right? We just want to educate people on how money works. I've met a couple of people, and what I find out is that not how much you make, but how much you can actually save. I've seen people make thousands, millions of dollars, but at the end of the day, they have nothing to show for it. So it is also important at this juncture to know where your money is growing, because if you don't control your money is going to control you at some point. So this is where we learn on how we can actually manage our money, how we can invest our money wisely, how we can grow our money, and how we can actually optimize taxes. So I'm going to quickly go into the presentation in order to share what I have for you today. Once again, thank you for joining. As you are joining, please type your name and where you are joining from. I'm super excited today to share this important topic with you. So while I just pull up my slide. Okay. So we're going to look at an important topic today. The topic is how to borrow from yourself, never the bank, the IFA strategies. How to borrow from yourself, never the bank, the IFA strategies. Everybody type IFA strategies. IFA strategies. So please, this presentation is for educational purposes only. Please seek advice from a licensed advisor before implementing any financial strategy. So this is not a financial or tax advice. All right, please be very careful. If you want to implement any strategy, consult your advisor, consult your legal practitioner, consult your tax expert on how to implement this strategy. So let's look at what is IFA. The IFA stands for the immediate finance arrangement. Immediate finance arrangement. Now, what does this immediate finance arrangement mean? The IFA strategies. It's a sophisticated financial approach that combines permanent life insurance with leveraging strategies to protect assets, build tax-free wealth, and maintain liquidity. So it is an arrangement that designed in such a way that you have access to protection, and of course, you also have access to, liquidity. You can also maintain liquidity. One of the things that many people doesn't want to set up life insurance is because, they don't have access to their money, especially at initial stage of the plan. Like if you run an illustration and you say, hey, you're going to be saving $500 per month, and you can start accessing money, let's say from year 3, from year 4. So probably feel reluctant to say, why would I have to wait for that long before I start accessing money from my life insurance policy, especially if you set up a cash value life insurance. I'm talking about permanent life insurance this time around. So in order to actually resolve that type of problem, this arrangement will help us to give access. It will provide immediate access to your money, as opposed to the traditional life insurance that if you set it up, you have to wait for so many years before you set it up. But there is a way to set it up. It's not just any type of life insurance this time around. And it is not all advisor that can actually do this. We have advisor that specializes in leveraging, right? Leveraging on life insurance for, for different financial arrangement. Okay, so please bear in mind that not all the advisor that can do this. So you need to seek expert advice from, advisor that specializes in immediate finance arrangement. Now, number one, let's look at protect your wealth. Insurance coverage safeguard asset. Now, the first thing is that you need to set up a life insurance, right? So life insurance, of course, we know that life insurance is just a strategy to protect asset, to protect life, to protect. When I said asset can be so many things. We have human resource asset. So if you set up a life insurance, right, if you have a critical illness, you are using it to replace your income. So think about it from this perspective, that you are the only asset that you need to actually protect. So you need to set up a life insurance. That person must qualify for life insurance. Now, growth tax rate, the cash value compound without taxation. So as opposed to other type of investment arrangement, like maybe stocks, bond, shares, real estate investment, that if you put your money in, you sell, you make profit, you're going to pay capital gain tax. In this type of arrangement, you don't pay such in life insurance cash value, and you can assess your money, borrow against policy while it grows. There are various ways in which you can actually take money from the life insurance. You can borrow against the cash value. You can actually withdraw directly from the cash value, and you can collateralize that particular policy for, you can also collateralize the policy. So it all depends on what is your financial goals. What are you looking for when you are setting up this strategy? So let's go further and let's look at the introduction to immediate finance strategy. So now, protect wealth while maintaining assets, no sacrificing liquidity for protection. Now, like I mentioned earlier, right? If you save money in a life insurance, right, especially the cash value life, I'm talking about permanent life insurance, all right, it will take some years, it will take some time before you can have access to that particular money. But in this case, you are not sacrificing the money you put in against your protection. Now, think about it. You have a life insurance. Let's say you have a life insurance of $1 million, $2 million. You put $100,000 in, and you can still have access to that premium that you put in. That is what we are talking about here, right? But you need to be very careful when you are setting it up, when you are setting up these strategies. It's not something that you can any advisor can set up. There are so many processes. There are so many things that you need to put into consideration before you set it up. Okay. Now, grow money tax-free over time. Compound growth without tax drag. Now, like other form of investment, like I mentioned earlier, like for example, if you buy bonds, if you buy stocks, right, and you make profit on it, the profit you make from that kind of an investment, you're going to pay tax on it. But in this case, you are not paying tax on it. Depends, especially when you follow the rule of the game, because there are different scenarios in which it can lead to tax disposition. But if you follow the rules of the game, now it's just like you go to the clinic and you meet a doctor, and doctor tells you, this is the drugs that you need to take, this is the medication, you need to take this one like this, you need to take this one like that. If you don't follow that, if you don't follow the instruction from the medical professional, that thing will not work as they're supposed to. So same as this strategy. So you need to follow the process. You need to follow the strategies behind it. If you don't follow the way it's set up and how you can actually leverage on it to build wealth, is not going to work the way you want it. So you need to follow the process and advice from the advisor what you need to do to assess your money. Ideal for high income professional. Doctors, lawyers, business owners benefit most. Now, so in Canada, I don't know of any other country. In Canada, for example, if you have a corporation, right, you make money from the corporation, right? The profit after tax from the corporation, if you reinvest it, you're going to pay what you call passive income, especially once you make more than $50,000 on passive income. It's subject to, you can pay up to 50% on taxes. So this kind of a strategy is very good for people who have a lot of money in their retained earnings. So if you put the money here, okay, number one, you're going to save a lot of money from taxes. Of course, you are also going to the money will also grow tax deferred. So it is not just for anyhow individuals. It is for people that is looking to build wealth and to invest a lot of money in their retained earning. What is an immediate finance arrangement? Now, fund insurance policy. You pay premium into the permanent life insurance policy. You borrow against the premium and policy cash value. There are two ways to take money out, to borrow money from this arrangement. Number one, you can borrow against the premium you put in. Okay. Two, you can also borrow from the cash value, but care must be, now you have to be very careful here. You cannot start borrowing and at the same time borrow from the premium and borrow from the cash value at the same time. It doesn't work that way, right? So if you start, say for example, you have $2 million of permanent life insurance, okay? The corporation is going to be the payer, the corporation is going to be the owner, the corporation is going to be the beneficiary, all right? While you, the business owners, or the key person will be the insured. Okay. Now, the premium you put in, you can borrow against that particular premium immediately. Let's say, for example, for that $2 million, $3 million of permanent life insurance, you put it $100,000 into it, you can borrow the $100,000 immediately. Okay. Now, if you borrow it back, right, there are so many things that are going on behind the scene in terms of the interest which we are going to be talking about as we proceed. Now, if you start borrowing against the policy premium, you cannot come back and say, hey, I want to borrow against the cash value, because as you are putting the money in, the money compound and grow tax-free. Okay. And three, access capital. You can get back up to 90% of premium immediately. Everybody type access to capital. Access to capital. So, this is very good for business owners, for people that are real estate investors, people that are looking to have access to immediate cash and also build wealth, right? Or you are looking for legacy, legacy planning. Now, I've met a lot of people and they kind of investing a lot in real estate. Let's say they have 5 houses, 10 houses. The question I used to ask them is this: now, you are buying real estate, right? Have you ever thought that if there is no proper arrangement, there's going to be taxes on those investments that you put in, especially capital gain taxes? So as you are putting in those investments, right, you need to think that as I'm growing wealth, I need to also provide or put strategies in place to mitigate the taxes. Because if you are, the more assets you have, the more tax you're going to pay, especially if it is not a life insurance policy. If you invest in any form, invest in real estate, of course, it's a very good way to build wealth, but you need to think about the tax implication of those assets that you are putting in. Now, who benefit most from IFA? Number one, medical professionals. Everybody type medical professionals. So physicians and business owners with surplus cash flow. Now, this is not for just anyhow individuals. Now, you must have enough surplus cash flow. You are not putting the premium monthly, it is lump sums. If you are doing $100,000, the money needs to come in once. If you are doing $200,000, the bank need that money to reflect in that particular policy, right? And there are a lot of processes that must have take place before you set it up. They have to qualify. They must have pre-approved you for the policy loan, right? Before they set up the insurance, right? Business owner, everybody type business owner. Entrepreneur with retained earnings. So if you're an entrepreneur and you have a lot of money sitting down in your retained earning, I'm talking about profit after tax. It is not This is profit after tax. After you must have make money from your corporation, the remaining money or the profit you make is what we call retained earnings, right? If you have surplus retained earning as an entrepreneur, this type of an arrangement is also good for you, right? Estate planners, anyone needing tax efficient wealth transfer. If you have a lot of money and you are looking to transfer wealth to your beneficiary, to your family when you pass, this is a powerful strategy to achieve that while you still have access to that money while you are alive. Now, let's just understand is that this type of arrangement, okay, serve two purposes. You have a life insurance and you also have access to your money, right? So I've seen many people, if you are an insurance agent, you run an illustrations, tell the client, okay, you're going to start assessing your money from year 6, from year 7, from year 8. In this type of arrangement, you start assessing money from year 1. And that give them opportunity to say, hey, I'm not going to put the money. So as a business owner, you don't want to put your money in an investment that you cannot have access to. Instead of, they will tell you, instead of me to put the money here, I'd rather use the money to buy stocks, shares, or bonds, or use it for real estate. But if you show them the value of you put the money here, right? Instead of you to go and put the money directly into real estate, you put the money here, you borrow against the money immediately to go and invest in real estate. So it is just a strategies in which you eat your cake and you still have it. Is a powerful strategies. All right. Let's go further. Core component of an IFA. Everybody type IFA. Everybody type IFA. Core component of an IFA. Number one, permanent life insurance. You can either use whole life insurance or universal life insurance. So there are two. You cannot set this one up on a term insurance. It has to be permanent life insurance, and there is a way to structure it. You cannot just, you can't just structure it like the normal life insurance that is actually meant for protections and maybe have access to your money later in life. No, we are talking of immediate access to your money, which is liquidity, because the business owner, the medical professionals, like they want to build wealth outside their medical practice. Entrepreneur that want to build wealth outside their corporation. That is what we're talking about here. Number two, bank loan. Everybody type bank loan. Bank loan. Secure against premiums and policy cash value. Like I said, you have two ways of assessing money from your policy. Number one, you can borrow against the premium, all right? You can also borrow against the cash value, right? You can borrow against the policy premium, and you can also borrow from the cash value. So, but you need to sit with the advisor and ask questions. When can I start borrowing from the cash value, right? What is the interest and some other conditions that will be applicable for you to, put this type of arrangement in, right? Like I said, it is a sophisticated strategies. It is not just for anyhow person. It is not meant for just anyhow advisor. There are advisor that specializes in IFA. So you need to meet an advisor that understands these strategies and how to set it up. 3, capital funding. Everybody type capital funding. Capital funding. Now, corporate or personal retained earning. Now, these are two things, right? We have corporate retained earnings, we have personal retained earnings. If you have a lot of money, all right, if you're a personal, if you have a lot of money sitting down after tax, you can also set it up. It's not only for business owner alone. Okay. Let's say, for example, you are making a lot of money, okay, and you after your tax, you have maybe $100,000, $200,000 sitting down in your retained earning, and you don't know what to do about it. You can consult an IFA strategist to set it up for you, right? It's a powerful way to mitigate tax and also to build wealth. Corporate, corporate individuals, and we're talking about corporation this time around. And I'm not talking about setting up on your corporation. I'm talking about setting up on your holding company. We're going to discuss that, later as we move forward in presentations. Everybody type capital funding. capital funding. So you can also use this either for corporate or personal, right? Now, how the IFA works step by step. How the IFA works step by step. Now, the IFA strategies follow a four-step process that allow you to purchase insurance while maintaining access to capital for continuing investment and growth. Let me just explain a very quick things here for you, and let me show you, let me open your eyes to how people build wealth quickly. Now, if you have somebody who has a chunk of money, let's say, for example, medical professionals who has a lot of money they are retaining and want to go into, let's say, commercial real estate, and you want to invest, let's say, $500,000, right? So instead of you to take that money to the bank and say, hey, I want to buy, let's say you want to invest on, let's say, $5 million project or $3 million project, okay, and you ask to maybe put up maybe 20% down, and maybe whatever amount they ask you to put down, and let's say the $500,000 is your down payment, right? That kind of money you can use it to set up the IFA. What are you trying to do? You buy life insurance policy, permanent life insurance, you put the premium in, and you borrow against that premium to go and do your commercial real estate. You can see, right, that in this case, you are using one stone to kill two birds. Now, you have insurance policy protection in place, right? And you also have access to your money too. The cash value continue to grow tax deferred, such that later in life you can still have access to cash value. Everybody type leveraging. See, leveraging is one of the important things that we individuals, business owners, need to understand when you want to grow wealth. Now, number one, you purchase insurance, acquire permanent life insurance with cash value. I'm not talking about term insurance this time around. I'm talking about permanent life insurance, right? You first qualify for the permanent life insurance. You must be able to pass through the underwriting process. You must be insurable. You must have good health. If you don't have good health, probably they are going to rate the policy, but not everybody can qualify for this. That's what I'm trying to say here. Two, assign as collateral, secure bank loan with the policy. Now, before you put the application in place, the IFA strategy teams must have qualified you. Check your financial report, check your cash flow report, your balance sheet, your cash flow statement, your profit and loss, your credit scores. There are so many things that they are going to look into, right? Once all those things is in place and everything is fine, right? They submit to the institutions that want to pre-approve you. They pre-approve you before you set it up the life insurance. So if you don't know how to do this, please, after this presentation, you can scan the QR code. I can walk you through. We have a team of advisors that specializes on this, right? I'm not just working alone on it. I have a team of advisors that really specializes on this one. But this is one thing that I want you to know here, that not all the advisors that can do this. That's what I'm trying to say here. Now, borrow premium back, access up to 90% of the premium paid. Now, you put $100,000 in, you have access to $90,000 immediately, or you have access to $100,000 immediately. Okay, everybody type borrow premium, borrow premium, borrow premium. Now, a lot of us don't know that. Oh, so I can borrow my premium. Yes, you can borrow your premium, but there is a way to structure that in order for you to borrow against your premium. I've seen people that ask me, okay, if I put I want to, I want to buy a house, and can I set up a life insurance? And and the premium I put in, maybe after like a year, I can buy a house. Of course, it all depends on how to set it up and how much you are putting into it. But in most cases, it is not always, guaranteed. Okay, if it is not IFA, it is not always guaranteed. I will encourage you and I will advise you, please make sure you seek professional advice before you put that kind of strategies in place. Reinvest capital. Everybody type reinvest capital. Use for businesses or investment purposes. Now, what we are trying to say here is that, so the premium you put in can be reinvested back into another another investment. I've talked about real estate. Let's say, for example, you want to go into stock trading. Now, you know that stock tradings It's an extremely volatile investment. Everybody type volatile, volatile. So if you are putting your money in stocks, bonds, shares and all of that, it's kind of volatile, right? Now, you don't want to put your egg in one basket, right? Instead of you to expose that money to extreme volatility, okay, you put the money in a guarantee investment, especially if you use whole life to set it up. 100% guarantee, right? You put the money there, all right, then borrow against the money and use it for whatever you want to use it for. So you don't need to, you don't want to expose all your assets into in a volatile position. Everybody type diversification. So you must, as an investor, as somebody who want to build wealth, you must learn how to diversify, right? If you want to go into real estate, right, put your money in different investment options. Buy a little bit of stocks, shares, bonds, real estate, life insurance, so that if one is not performing, other one will perform. I met a one of my clients. I met him at some point, and I was asking him questions. And okay, what exactly? How do you really want to plan for retirement? Mr. Fasola, my experience is this, right? I have tried so many things in this country, and one thing I've learned is that I've learned not to put my egg in one basket. So everybody type, don't put your egg in one basket. Never ever put your egg in one basket. Now, if you don't understand how life insurance works, especially permanent life insurance, consult advisors that will expose you, because our perceptions, especially where we came from, is that life insurance is for death purpose. No, it's never like that, right? Life insurance is not for death, right? You can see that life insurance can actually be put in place, for liquidity, for expansion, for business expansion, for operations and all of that. So it all depends on the purpose and the reasons why you set up. Let's look at the example of Dr. J. IFA example of Dr. J. Now, this is an incorporated physician. Now, so this is a case study of an incorporated physician using IFA strategies with 100K annual premium over 10 years, assessing 100K annually while building $3 million tax-free death benefits. So this is not, this is just a specific to Dr. J. So if you are not Dr. J, this might not be applicable to you. And that is why you need to seek professional advice before you venture into it. Now, let's say, for example, Dr. J is putting 100K annual premium. Everybody type 100K annual premium, 100K annual premium. And let's say Dr. J want to pay for 10 years. So meaning that in the next 10 years, Dr. J must have paid $1 million, right? Now, as Dr. J is putting money into the policy, okay, Dr. J is also borrowing the premium again. So in the next 10 years, Dr. J must have accessed $1 million. Wow. Guys, let me tell you this, right? If you don't understand how money works, you continue to work for money. And honestly speaking, I've seen people, they make so much money, yet they are still poor. So it is not how much you make. We have people that are making $50,000, $70,000, $100,000, and they built massive wealth. And we have people that are making $1 million, $2 million, yet they cannot build wealth, right? So the difference between the two of them is they have access to information and they leverage on compound interest. If you don't know how to do this, consult your advisor. Don't work for money. Let your money work hard for you. Every type, my money must work hard for me, right? Don't work for money, right? Let your money work hard for you. And this is some of the way in which your money can work hard for you. So imagine at death, right? This particular Dr. J still have 3 million death benefit paid to the capital dividend account. Everybody type CDA. The meaning of CDA is capital dividend account. It's a notional account set up for all the incorporation, right? If it is not structured properly, right, it's going to trigger tax. So you want to talk to an advisor that understands how it's being structured. So again, if you are structuring this type of leveraging, if you're structuring this type of strategies, the corporation must be the payer, the corporation must be the owner, the corporation must be the beneficiary. That is how to set it up, right? Let's go. The tax advantage. Everybody type tax advantage. The IFA strategies offer multiple tax benefits, deductible loan interest, tax-free policy growth, and tax-free transfer of debt benefit. Now, in other type of investment, like for example, if you buy stocks, right, the at deemed disposition, you must pay taxes, right? You have to pay capital gain tax because you are investing, right? If you're investing on those type of investment, right, you have to pay tax. But let's look at the compared to the IFA, right? Deductible interest. Loan interest may be tax deductible if used for income. Depends on the way you set it up, depends on the usage of the income. You can claim it as tax deductible. Now, let me just explain a bit further on that, right? Let's say, for example, the total expense for the corporation is, let's say, $50,000, and the interest paid on the loan is, let's say, it's about $10,000. So meaning that you are still going to claim that as a tax deductible because it's part of the expense to the corporation. All right, it's part of the expense to the corporation. So if at the end of the day, if the profit is supposed to be $60,000, so meaning that the 10,000 is going to reduce the profit, right? Reducing your tax after the profit after tax. It makes sense, right? To see how can I reduce my taxes? How can I optimize my taxes? Like I said, I don't have any problem in paying taxes, but if there are legal way, all right, to leverage on how I can optimize my taxes, then do it, right? Speak to people that understand these amazing strategies to help you mitigate the risk of, taxes. Okay, these are legal way of reducing your taxes. Two, tax-free growth. Everyone type tax-free growth. No capital gain tax on the policy growth. Now, if you invest on real estate, okay, at the end of the day, whatever, let's say for example, you buy $500,000 house, after many years, the house appreciating value, and you flip, whatever profit you make there after the adjusted cost base, you're going to pay tax. But in this case, right, the cash value growth tax deferred. And so because you are taking loan against the policy cash value, because you are taking a loan against the premium, it's not going to be subject to taxes. So you need to understand how to leverage these particular strategies to build wealth. Now, three, tax-free transfer. Everybody type tax-free transfer. Tax-free transfer. Debt benefit flow, tax-free, fair capital dividend account. Now, CDA. Everybody type CDA. CDA. Now, you need to understand all these concepts as an advisor, as a business owner, as a medical professional. You need to understand these simple terms, right? I used to tell people, right, your accountant cannot build wealth for you. I've presented to so many medical professionals, and they get back to me, Mr. Fasola, I'm going to get back to you. Let's talk to my accountant. It's good. Of course, there is no way the accountant will not also know about it. But the truth of the matter is that your accountant cannot grow wealth for you. Your accountant cannot plan for your retirement. Your accountant cannot put strategies in place for estate planning for your family. It is your responsibility to plan for your retirement, to put strategies in place for estate planning, right? It can help you to prepare your account, look so good. If there's any audit from CRA, advise you, guide you on how you can actually, mitigate the risk of taxes here and there. But what about the money you make from your corporation, right? Is not an It's not an investor. You not be the one to say you go and invest your money here. It is your responsibility to get information on how you can grow wealth, especially in a tax-free environment. Everybody type tax-free environment. Tax-free environment. So, because if you are growing wealth and you are not growing in a tax-free environment, tax will kill you. Okay, so let us understand these strategies, okay? Because especially for those people that does not understand what life insurance is, a lot of people, they have crossed their mind and say, hey, I'm not going to put my money in any type of strategies where somebody will not begin to enjoy the benefit. Of course, you are not putting your money in strategies where somebody will enjoy your money. We're talking about while you are alive, you have access to your money. Now, why use an IFA instead of just savings? The IFA strategies offer superior financial advantage through leveraging assets, tax optimizations, and maintaining liquidity. Now, look at this one, right? Multiplied impact leverages retain earning. Everybody type retain earning. So why we are talking about retain earning is that there are things that we need to understand when it comes to building wealth. If you have a corporation, okay, your corporation is a legal entity that can be sued and be sued, right? We have cases where it can be subject to litigation. If you have issues, maybe there is a litigation against your corporations, and it's really like affecting the corporation. If you have a retained earning, you set up a holding company and you put the profit from the corporation and you put it in that holding company in such a way that it's going to be safe. So you separate your retained earning from the main corporation. So understand this. Okay, reduce taxation both now and for estate. As you are borrowing against the premium, as you are borrowing against the cash value, you are not going to pay tax. And of course, the money go through the capital dividend account tax-free to your beneficiary. Preserve assets. Capital remain available. So you don't need to wait to have access to your money. You have immediate access to liquidity, especially for those of us who are going into investment. Okay, it is not about, like I said, it is not about how much you make. Some of us, we don't want to take risk. I've seen a lot of people, no, I don't want to take risk. I want to put my money here. Well, the truth is this, right? If you are not ready to take calculated risk, it's going to remain like that, because that money cannot do anything for you if you don't put it to work. And for you to put it to work, you must do your due diligence, work with professionals that will help you to multiply wealth. Now, benefit of the IFA strategies. Benefit of IFA strategies. The IFA strategies offer tax advantage, maintain liquidity, enhance retirement planning, and provide asset protection. So now look at this one. Now these are the key points here. Now, note this. Number one, offers tax advantage. 2, maintain liquidity. 3, enhance retirement planning. 4, provide asset protections. Other investment can actually do the same, but look at the features of this, right? There are key points here that I want us to take home. Now, tax sheltered growth, compound without annual taxation. So the money you put in that strategy is compound without annual taxation. Like I said, if you make profit from your corporation, your retained earning, if you reinvest it, once you make more than $50,000, you will pay passive income of up to 50%. It's just like, you can see, if you don't know how to really manage your money, you cannot build wealth. And tax is number one biggest destroyer of wealth. Let me repeat myself. Taxes is number one biggest destroyers of wealth. I've seen people that go out of business because of taxes. So the more money you make, the more tax you pay. But in this case, your money grow tax deferred. I mean, if I ask you which one do you want to do, you pay tax or don't pay tax? Put in the comment section. Do you want to continue to pay tax, or if you have a legal way of optimizing your tax, you're not going to do it? Type yes or no there. Which one? So everybody is looking for a way to optimize their tax. Like I said, don't get me wrong. I'm not saying that other investment is not good. All right. I've said it earlier that we need to diversify, right? At least have different asset classes because each of them perform different functions. But the truth of the matter is that which one can I put my money that will give me tax advantage? We're talking about tax advantage type of account here. So this is one of the best tax advantage account that you can put your money and you still have access to liquidity. Two, access cash without selling asset. Now, some other type of investment like stocks, if you need money, you sell your stocks. Of course, the profit you make, you pay tax on it. Unlike this one, you don't sell it. Okay, you only borrow against the cash value. You only borrow against the premium. Your money still continue to grow. Compounding is to continue to grow tax free. So you must understand the difference between selling with cash without selling asset and selling with asset. If you sell other type of investment, you make the profit. If you invest in real estate, you sell the house, you make the profit, but you don't have the house again, right? Once you sell, you don't have the house again. But in this case, you still have access to your life insurance. You still have access to your cash value. You still continue to grow tax deferred. Anytime you pass, whatever you take out of the policy will be deducted from the total debt benefit, the remaining balance paid to the capital dividend account. So don't forget, this is not for individuals. We're talking about the corporation this time around. Okay. Enhanced retirement income, tax efficient withdrawal. So, if you have investment like tax deferred, like registered retirement system, for example, right? So you take money from it, you pay tax, right? Although at retirement, the tax may not be as much as it used to be if you are still actively working, but the fact is that you are still going to pay tax. Do I say you should not do it? No, right? Spread your asset. Everybody type it now. Asset, spread your asset. Spread your asset. Don't put your money in one basket. Asset protection, safeguard from creditors. Now, this is another very important point you need to consider, right? This is creditor proof. If you are owing creditors, owing a lot of debt here and there, this is creditor proof. Now, creditor will not be, running after it. What happened at debt? What happened at debt? Upon debt, the IFA strategies provide a structured process where the bank loan is repaid from the debt benefit with remaining funds flowing tax-free to beneficiary through the capital dividend account. Wow. I wish I know this when I started my business, and I wish my dad or my mom knew about this. Maybe they would have said this one or for me, right? But it's unfortunate because of lack of financial education how people are actually missing out, right? I did a presentation today, and the folks was telling me, I said, look, the only insurance that is compulsory in this country is only car insurance and house insurance because the government mandate us to do that. And I said, that's great. That's very perfect. But you know what? How much are you paying on your car insurance? And he calculated it. How much are you paying on your home insurance? You calculated it. I said, do you pray to profit from those insurance? Answer yes or no. He couldn't answer. I said, well, pray that you want to profit for your car insurance because you are praying that you want to have an accident. If you survive it, so you are paying about $3,000 on your car insurance that you never pray to profit from, and it is difficult for you to protect your life. I said it's a lack of financial education, and that is why people remain poor, right? It is our duty. I wish everybody look. at this business beyond commission and be extremely passionate about educating people. People don't have financial education. They don't understand how money works. And this is why we are in the business, to educate them, not to sell. The guy said, I'm not going to sell insurance. I said, forget about it. I'm not selling insurance to you today. I'm educating you on why you must protect your family, why you must take actions today. If anything happened to you today, what do you think is going to happen to your family? You are married, you have children, right? So now, a lot of us think that life insurance is just, about death alone. Now, the Bible says a good parent leave inheritance for his children, right? If you agree, type say yes. If you don't agree, type no. Because why? I've seen folks like they say, no, I have a lot of money. I don't need insurance. Somehow, what do you think might cause that? It is lack of financial education. Okay, at today, this is what happened. Loan repayment, bank loan settled from the death benefit. Now, what's going to happen at death is that whatever you have drawn over the years from the policy, right, to be deducted from the total death benefit, right? Now, they would now deposit the money into the capital dividend account. The remainder flow to CDA, right? Everybody type CDA. CDA. I really want you to understand this simple concept. CDA is capital dividend account, right? And the tax-free distribution paid to estates or beneficiaries. So when you are setting up the policy, especially for the corporation, okay, you must involve lawyers because there must be some documentations in order for the benefit to transfer smoothly to the beneficiary. Don't forget that the money is not coming directly to the beneficiary this time around. It must first go through the capital dividend account for tax planning purposes. Okay, and from there it will begin to flow to different accounts, to the share with the children, the wife, and all of that. So you must make sure that you structure it in a proper way. Now let's look at immediate finance arrangement versus traditional investing. So we're going to look at it one by one in order for you to understand that this is a powerful strategy on taxable growth. Traditional investing. Now, if you put your money in terms of tax, annual taxes on gains, I've repeated this over and over again. If you agree, type yes. If you don't agree, type no. Because why? I really want us to understand the importance of IFA, right? Now, annual taxes on the gain. If you put your money on any form of investment, you're going to pay capital gain tax. But in IFA strategies, tax shelter growth. Now, liquidity. Now, in traditional investing is limited, may trigger taxes, depends on if you put money on some of the investment, right? If you withdraw more than what you're supposed to take, it might trigger tax depending on the way you take the money out, right? But in IFA strategies is very high, right? 90% accessible via loans, 90% accessible via loans. Estate efficiency is low, subject to disposition taxes. In IFA, it's high, right? Because the tax free via capital dividend account. Creditor protections. When it comes to creditor protection, is minimal. Most investments are exposed to creditor protection. If you put your money in those other type of investment like stocks, like bonds, like shares, and all of that, it probably might be exposed to creditors. It might be exposed to creditors, but in IFA, it's very strong, protected by legislation, because life insurance by nature is protected from creditors. Okay, if you agree, type I agree. If you don't agree, type I didn't agree with it, because some people say no. But the whole essence of why we are doing this is for you to open your eyes to what should I do, or how can I actually leverage on these strategies to grow wealth? And if you know the difference between the IFA and other type of traditional investing, you'll be able to pitch this to business owners and medical professionals. I really focus on medical professionals because why? They are one of the top, earners in this country, and a lot of them, they have so much money sitting out in their retained earnings, and they don't know how to, they don't know what to use, they don't know what to do with the money, right? It's just sitting down there every year. They make so much money after their corporation profit, after tax. They make, some of them make $200,000, $300,000, and they don't know how to use the money. So this is our job, to go to them and say, hey, you can actually leverage on these strategies by putting your money here without paying so much taxes, and all the interest you incur even when you are borrowing from the policy, when you are borrowing against the cash value, is also tax deductible. Now, key consideration. Now, care must be taken here. The IFA strategy requires medical qualification, long-term planning, and proper legal structuring to be effective. So now you can see here, right? Now, it requires, number one, medical qualifications. You must qualify for medical underwriting. Long-term planning is not something that you can set it up today and say, hey, I'm not going to do anything again. It will continue. No, there must be annual review. We have to be sitting down every year to look at your balance sheet, to look at your all the components of financial report, the profit and loss, and the cash flow statement, to know if your corporation is healthy. Because once the going concern is being threatening, it's going to affect this strategy. So you should have liquidity. You have the enough, part to continue to pay the lump sum premium every year. And it also depends on how healthy your company is, and this will be detected in the financial report. Okay, so, and again, there must be proper legal structuring to be effective, especially when the money flow to the capital dividend account. Lawyer has to be involved. They have to draw a lot of agreement to make sure that the money flows out without any form of issues, right? Number one, medical underwriting requires you have to pass through medical underwriting, right? When they are doing when they put up the application, you have to pass through the medical test. They have to do the blood work and all of that. Do your, not only medical underwriting, even the financial underwriting. You must not have any form of bankruptcy and all of that. And if it happens, so you must have a clean record of that before they set it up. Right now, the reason why they are doing all of this is because they want to make sure that you qualify before they put the application out to the bank. So medical underwriting also has to do with your lifestyles. You must make sure that if you're that kind of a client who just drive roughly, you don't just care about your life, you may not be able to qualify for this type of strategy. So you must be very careful when it comes to medical underwriting. Long-term commitment, not a short-term strategy. So think about it, right? If you are doing a lump sum for the next 10 years, that's almost $1 million. So, and every year, okay, we must review to know that if there are key areas that you need to focus on. For example, if your liability is just increasing and increasing and increasing, let's say, for example, the following year, the ratio of asset to liability is gonna go into 3/4, or maybe your liabilities maybe times 3 of your asset. Your liabilities times 4 of your asset. That's a red flag here. Okay, the ratio should be maybe 2. Your liability should be 2 to ratio 4 of your asset. Like, you must have enough asset to cover your liability. But when your liability is so much that it affects your operations, is a very big concern for the bank. So in that case, they have to work with you to make sure that they put something. Probably maybe you are over trading in some areas. Maybe you are taking a lot of credit facilities from banks, and you don't want to put yourself in a serious problem. And it's proper structures, legal and tax setup is very critical. You need to work with your accountant. We need to work with the lawyers to make sure that everything is very perfect. Okay, and common misconceptions. No, the IFA is a sophisticated yet accessible wealth strategies that leverage insurance policy to assess capital tax efficiently. Work for professionals with consistent surplus incomes, require minimal ongoing management. The first misconception is the IFA is just another form of debt. No, the IFA is not another form of debt. The IFA is a wealth leverage tools allowing access to your capital without triggering taxes. Again, it requires no legal regular repayment. It doesn't affect your credit rating. So a lot of people think that, oh, if I put this one up, it's going to affect my credit rating. No, that is a total misconception. Misconception number two: setting up an IFA is too complicated. Of course, it's a sophisticated product, but your advisor handle all complexity from policy structure to tax treatment. Most clients spend under 3 hours annually on their IFA after setup. So it is a complex strategy, of course, but then we have specialists that look into this for you. Three, IFA only work for the ultra wealthy. No, anyone with consistent retained earning can benefit. Professional with annual surplus of income of about $100,000 can implement effective IFA strategies. It's accessible to incorporated professionals, business owners, and individuals with steady surplus income. Amazing. So it's not just the way people see it. It just depends on, you just need to understand how it works and how they can actually help you to set it up. So this is your IFA advisory team. Now, the life insurance specialist is the first person that is very key in this arrangement, because the life insurance product, we want to design optimal policy structure. The tax advisor ensure maximum tax efficiency. To also accountant has to be involved. We have all of that. Right. The legal professionals handle corporate structure. So the legal professionals, the lawyers is going to look at the corporate size of it, how the money will flow to the CDA, to the beneficiaries, and the banking partners like facilitate leverage financing. So the bank must be ready to take this arrangement. Not all banks that take it. So before you go into it, you must have a bank that stand by and say, hey, we are really ready to take up these strategies. And we have a lot of banks that we partner with that will actually help you to make these strategies work. So action steps to start. Now, starting your IFA strategy requires assessment of eligibility, financial analysis, personal plannings, and coordinated implementation with your advisory. Number one, determine insurability, complete health assessment, review cash flow, analyze corporate through personal finance, get custom proposal, request policy illustration with IFA details, and execute strategies with advisory team. Okay. Now, why borrow from yourself? Why do you want to borrow from yourself? You pay interest order with restrictions and approval hurdles. So that is if you borrow from the bank. But look at the traditional savings, right? Taxable growth with limited access and slower wealth building. That is if you do traditional savings. But look at the IFA, right? Wealth protection growth and access with tax efficiently. The IFA protect, grow, and access your wealth efficiently, right? So thank you so much. I'm going to stop here, and I will quickly if you have any question, we can quickly look into it. So if you need more information on IFA, all right, or you want to learn more, okay, you can just scan this QR code, and I'm ready to work with you freely. This at no cost, right? I really want to expose you to more information about IFA. I want to thank everyone for joining today. It has been an amazing session. I really want to appreciate everyone. It's a powerful strategies for people who really have a lot of money in their retained earning in order for them to grow well. If you have any question, you can just put it in the chat before we close. Any question, please? Any question? Any question? Any question? Any question? All right. I want to thank my friend here, Professor Kolakbo Ige from United States of America. Thank you for joining. Adejoke, thank you for joining. Opportunity Finance and Economy, thank you for joining. Olubola Fasola, thank you for joining. Godwin, thank you for joining. And yeah, thank you so much, everyone, for joining tonight. It has been a very fantastic session. We're going to call it a day here, and tomorrow and next week, same time, is another time to look into another powerful topics for wealth building. Once again, thank you so much, and see you next week. Bye for now.